Every crypto investor thinks their biggest risk is picking the wrong coin. It isn't. Study after study on retail trading behavior finds the same result. The average investor doesn't underperform the market because they picked bad assets. They underperform because of what they do after they buy. They panic sell during crashes and buy back in after recovery's already happened. They hold losing positions too long, hoping to break even, then sell winning positions too early out of fear of losing the gain. They check prices constantly, and every check triggers a decision, and most of those decisions are wrong ones made from emotion rather than strategy. This isn't a character flaw unique to bad investors. It's how the human brain is wired, and crypto's volatility and 24/7 markets make it worse than almost any other asset class in history. This video breaks down exactly what's happening in your brain when you trade, the specific psychological patterns that quietly destroy returns, and the mechanical fixes that remove emotion from the equation entirely. Behavioral economists have documented for decades that losses hurt roughly twice as much, psychologically, as equivalent gains feel good. Losing $1,000 produces more emotional pain than gaining $1,000 produces pleasure. This asymmetry, called loss aversion, is the root cause of nearly every destructive trading pattern that follows. It explains why investors hold losing positions far longer than winning ones, hoping to avoid ever having to realize the loss and make it real. It explains why a 20% drawdown feels catastrophic even when the position is still fundamentally sound, triggering panic decisions that lock in losses that would have recovered if left alone. Crypto's extreme volatility means investors experience loss aversion triggering swings routinely that other asset classes might produce once a decade, which means the psychological damage compounds far faster and far more often. Directly downstream of loss aversion is a well-documented pattern called the disposition effect, the tendency to sell winning positions too early and hold losing positions too long. Investors want to lock in the good feeling of a win quickly before it can reverse, while simultaneously avoiding the bad feeling of confirming a loss for as long as possible. The mathematical result of this pattern, applied consistently across dozens of trades over months or years, is a portfolio that systematically cuts its winners short while letting its losers run, the exact opposite of the cut losses, let winners ride principle that virtually every successful trader eventually learns to follow deliberately, specifically because it doesn't come naturally. Human brains are wired to weight recent events far more heavily than historical patterns, a tendency called recency bias. In crypto specifically, this produces a recurring and well-documented cycle. During a bull run, recent price action is all gains, so investors extrapolate that gains will continue indefinitely, leading to overconfidence, leverage, and buying at tops. During a crash, recent price action is all losses, so investors extrapolate that losses will continue indefinitely, leading to panic selling at bottoms. This happens on a predictable cycle every single market cycle, and yet the vast majority of retail investors experience it as a surprise each time, because the emotional intensity of right now always overwhelms the intellectual knowledge of this has happened before and reversed before. Understanding where you actually are in a cycle, rather than reacting purely to how the last few weeks felt, is one of the single highest value skills a crypto investor can develop, and it's almost entirely about managing recency bias rather than predicting the future. Every market cycle produces a predictable emotional arc, regardless of the specific asset. Accumulation, when smart, patient money quietly buys while sentiment is depressed and most retail investors have already given up or lost interest, when boredom and disbelief are the dominant emotions. Markup, when prices begin rising and early believers feel vindicated, gradually attracting more attention and more buyers as optimism builds into excitement. Distribution, when prices peak and euphoria is at its highest, when, this time it's different thinking is everywhere. And when the investors who bought during accumulation quietly begin selling into the enthusiasm of latecomers. Markdown, when prices fall and denial gives way to panic, capitulation, and eventually depression, at which point the cycle loops back to accumulation. The single most consistent psychological mistake retail investors make is feeling maximum confidence exactly during distribution, when they should be most cautious, and feeling maximum fear exactly during accumulation, when disciplined buying has historically produced the best long-term results. A documented pattern across retail trading studies is that periods of success breed overconfidence, and overconfidence leads directly to larger position sizes, more leverage, and less risk management, right before markets typically turn. Winning several trades in a row, particularly in a strong bull market where nearly everyone is winning simultaneously, creates a powerful illusion of individual skill, when, in reality, broad market conditions were doing most of the work. This overconfidence is precisely why the investors who took on the most leverage and the largest positions during 2021's peak enthusiasm were often the ones who suffered the most catastrophic losses during the subsequent downturn, not because they were unluckier than everyone else, but because overconfidence had systematically eroded their risk management exactly when they needed it most. Crypto markets trade 24 hours a day, 7 days a week, unlike traditional stock markets with fixed open and close hours. This constant availability, combined with push notifications and price tracking apps, means many crypto investors check prices dramatically more often than investors in any other asset class historically have. Behavioral research on investment checking frequency has found that more frequent price checking correlates with worse investment outcomes, not better ones, because each check is an opportunity for loss aversion and recency bias to trigger an emotional decision. An investor who checks prices once a month experiences the same long-term returns as one who checks constantly, but experiences dramatically fewer moments where emotion overrides strategy. The 24/7 nature of crypto specifically removes a structural protection that traditional markets have always had built in: forced breaks between trading sessions that give emotional reactions time to cool before a decision can actually be executed. Crypto investing happens unusually publicly, across Twitter, Discord, Telegram, and YouTube, in a way that traditional investing historically has not. This creates powerful herd behavior effects on top of the individual psychological biases already discussed. Seeing others post gains creates fear of missing out that overrides an investor's own research and risk tolerance. Seeing widespread panic in the same online spaces amplifies an individual's own fear far beyond what the actual situation warrants, because humans are wired to treat visible social consensus as a strong signal, even when that consensus is itself just a crowd of people experiencing the same psychological biases simultaneously. The result is that crypto's most public, most socially connected communities often experience the most extreme, synchronized emotional swings, because the herd effect adds a multiplier on top of each individual's own loss aversion and recency bias. The psychological patterns described in this video are close to universal, which means willpower alone rarely overcomes them consistently. What actually works, according to both behavioral finance research and the practices of consistently successful long-term investors, is removing the decision point entirely wherever possible. Dollar cost averaging on a fixed schedule, regardless of price, removes the emotional decision of "should I buy now?" entirely, replacing it with a predetermined mechanical rule. Setting predetermined position sizes and sticking to them removes the overconfidence-driven position creep that typically happens after a winning streak. Deciding your sell targets and stop losses in advance, before emotion is running high, and setting actual automated orders rather than planning to. Decide in the moment removes the disposition effect's grip at the exact moment it would otherwise take over. Deliberately reducing price checking frequency through app limits or simply removing notifications directly addresses the well-documented link between checking frequency and worse outcomes. Every one of these psychological patterns exists in traditional investing too. Crypto amplifies all of them simultaneously through higher volatility, which intensifies loss aversion 24/7 markets, which removes the forced cooling-off periods traditional markets provide, and unusually public, socially connected communities, which adds herd behavior on top of individual bias. This is precisely why crypto-specific investor behavior studies consistently find worse average returns relative to simple buy-and-hold benchmarks than equivalent studies find in traditional equity markets. The asset class isn't inherently worse. The psychological environment surrounding it is simply more hostile to good decision-making, for structural reasons that have nothing to do with any individual investor's intelligence or discipline. The biggest mistake crypto investors make isn't a coin they picked. It's the mechanism running underneath every decision they make after buying it. Loss aversion, the disposition effect, recency bias, overconfidence, constant checking, and herd behavior are not rare failures of a few undisciplined people. They are the default human response to a volatile, always-on, socially amplified financial environment, and they affect nearly everyone to some degree, including experienced traders who intellectually understand every concept in this video. The solution isn't developing superhuman willpower. It's building mechanical systems, predetermined rules, and reduced exposure to constant price checking and social sentiment, specifically because those systems remove the moment where the biases described here get a chance to take over. Comment, "I've done this" if you recognize any of these patterns in your own trading, or already automated if you've built systems to remove the emotion already. Next video, I'm breaking down whether accumulation phase strategies actually beat simply buying and holding, with the real math behind dollar cost averaging versus trying to time the bottom. Subscribe to Unbanked. The old money had a head start. You have the internet.